Welcome to the Ellsworth Advisors monthly update for May 2025. I'm Kelly Keenan. This is Cameron Mealy. Today we'll review the latest economic data and also discuss how our portfolio has performed in May and where we're sitting year to date. So Cam, let's kick off with some economic data.
Thank you, Kelly. Good morning, everybody. Just so we set the stage, today is June 3rd, Tuesday, June 3rd. Let's start with interest rates. We have not had an interest rate cut since December 2024. The Fed is meeting June 17th and 18th. Current interest rates, target Fed funds interest rate is 4.25 to 4.5. I would be very surprised if the Fed did anything but stay under their current regime. Now, they're getting continued pressure from President Trump to cut interest rates. I don't think many economists would agree that that is the right course of action today. I do not see the Fed doing anything, at least until additional information, additional impact from the tariffs come in. So I think we're, coming mid-June, we're still going to be in kind of a wait-and-see mode.
Yeah, inflation still is not where the Fed wants it to be. Still elevated, closer to that 3% number. Tariffs obviously increase the price of goods. That's short-term inflation. Fed does not want to move too soon.
Well, and with uncertainty breeds kind of a wait-and-see approach.
Right.
Especially with the Fed.
Keep the dry powder and see how things go here.
Yep. So speaking of inflation, let's jump into the three major gauges of inflation as reviewed by the Fed. The Personal Consumption Expenditure Index. This is quoted as the Fed's leading gauge on inflation. On May 30th, Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.1% in April. For the 12 months ending April, the index is up 2.1%. Now, this compares to 2.6% in November, 2.4% in December, 2.5% in January, 2.8% in February, and 2.3% in March. So certainly this is a lower look at inflation.
PCE moving in the right direction.
Producer Price Index on May 15th. Bureau of Labor Statistics reported that the Producer Price Index decreased 0.5% in April. This is the second monthly decline in a row, and on a year-over-year basis, the index is up 2.4%, which compares favorably to the 3.4% increase for the 12 months ended March. So again, appears to be moving in the right direction. Consumer Price Index. On May 13th, the Bureau of Labor Statistics also reported that the Consumer Price Index increased 0.2% in April. This was after decreasing 0.1% in March. And on a year-over-year basis, the index is up 2.3%. So we're finally seeing interest rates kind of getting closer to that 2% target rate of the Fed. But obviously, with the tariff situation, global trade, there was a lot of uncertainty. And speaking of that uncertainty, there was an article in Reuters. This is from May 29th, so a couple of days dated. But this was Reuters' May 29th summary of the current economic situation. Weekly jobless claims increased 14,000 to 240,000. Continuing claims rose 26,000 to 1.919 million. Corporate profits for the first quarter were down 118.1 billion. And the economy contracted 0.2% in the first quarter based on GDP. So in reaction to this, Christopher Rumpke, who's the key economist at Forward Bonds, stated, "This is a sign that cracks are starting to form in the economy and that the outlook is deteriorating. There is nothing great about today's jobless claims data that jump off. Layoffs may be a harbinger of worse things to come." Now, behind that, we do have the May jobs report that comes out June 6th, this Friday. The consensus estimate currently is for the U.S. economy to add 125,000 new jobs in April, in May, which will be down from the 177,000 new jobs added in April. So we're seeing inflation come down. We're seeing a little bit of a tough situation in jobs, but again, with the economic uncertainty, you can see why hiring would not be as robust as it has been. We had talked earlier about first quarter GDP being down 0.2% on an annualized basis. Obviously, the thought is, and the data suggests that a lot of that is because people were pre-buying imports. Now we might actually see those imports coming back out into the economy because based on the June 2nd reading of the Atlanta Fed's GDP Now forecast model, the Atlanta Fed is projecting second quarter GDP to increase at an annualized rate of 4.6%. So nearly double kind of the normal quarterly growth we see. Again, that makes sense from the narrative of People were pre-buying imports because of tariffs. Now those imports are coming through the economy. So where they were a detraction in the first quarter, they'll be a net positive in the second quarter. Again, it's really hard to read anything into that number. That 4.2%, 4.6% is probably realistically more like 1.8 to 2.2%, a normalized number.
Right. First quarter skewed negative, second quarter skewed positive, kind of what we talked about a couple months ago. And once again, probably looking at even them out or realistic, where are we really at? Probably high single digit or high 1%, 2% range for GDP.
I mean,
which once again is what kind of we thought was going to be a softer growth year, still positive growth, but
we're
not
really
quite as strong as last year.
We're really going to have to be into the late third quarter, early fourth quarter, maybe even the end of the year until we really know how this tariff situation is going to play out into the economy overall. Again, every day we're hearing now that the European Union wants to negotiate. Reports just came out that China's manufacturing sector is really hemorrhaging jobs right now because their manufacturing is being hurt. So there's a lot of uncertainty out there.
Yeah, I mean, there's a lot of data, a lot of different stories you can tell, going back to interest rates. So slowing economy, inflation. Without the whole tariff issues, we would be looking at, probably getting closer to in line with the 2% inflation growth. The reality is the money supply really hasn't grown since 2022. So that's ultimately what drives long-term inflation. Now what we're seeing is, okay, that's the long kind of baseline inflation. Then throw on top of it tariffs and the other issues around tariffs. Those unknowns, that's kind of what's being reflected in inflation now. But if the economy continues to, show some softness, the Fed will probably, do something on rates, bring down those short-term rates.
Yeah, I still think 25 to 50 basis points in the second half of the year.
Second half of the year
is likely.
Seems realistic. That will definitely give a little bit of juice to the economy, revive things. It'll definitely take some pressure off the banks. You could see some pressure, taken off the longer-term bonds, just because banks will be able to, borrow short and lend long, obviously by longer-term bonds. That's the 10-year. That'll bring that down a little bit and, potentially get us back on track or kind of keep us from going into any kind of a deep, significant recession.
Which basically could set us up for a pretty good year in the stock market.
Exactly. And I guess my thoughts are, I've been saying this since the beginning of the year, we'll probably make money this year, but it's going to be a roller coaster.
It'll be a roller coaster.
And we've seen a couple big hills already, and there may be another couple ahead of us. I would not be surprised there. In May, so March was a horrible month. Kind of things got to the worst point in April, started recovering towards the end of April. May was, I would call it, full recovery from the pullback in March and April. In May, the S&P was up 6.15%. Dow Jones up 3.94. The NASDAQ up 9.56. Russell 2000, small cap stocks only up 5.2. International stocks up 3.97. The emerging markets up 4%. Bonds, though, down. The aggregate bond index down 0.72 in May. So that's kind of a result of higher interest rates. Year to date, that gives the S&P breaking into positive territory, up 0.51. Dow Jones still slightly negative, down 0.64. NASDAQ down 1.02. The Russell 2000, really the small cap stocks, they've struggled the most, down 7.35 year to date. International stocks have definitely been the outperformers. Year to date up 14.97 as measured by the EAFE. And then emerging markets up 7.61. Year to date, though, even though bonds were down in May, year to date up 2.45%. Our portfolios performed, I think, pretty happy with the way they performed last month. In May, the growth with income portfolio up 2%. Year to date, it's up now about 5%. Big gainers, Microchip Technology up 25%, Disney up 24%, Nvidia up 21%, Digital Realty, which we had at the beginning of the month, up 10%. So kind of a little bit of a rotation back to the tech play.
Mhm.
Tech stocks were definitely beaten down pretty hard into April. Seen good recovery there. Not quite back to where they were, but they're getting there. Big laggers. Nucor was down 9% in May. Just yesterday, it rallied 10%. So kind of back to where we were with Nucor. Apple down 6%. Berkshire Hathaway down 5%. Year-to-date gainers, though, Berkshire still up 11%, Visa up 16% year-to-date, Raytheon up 18%. Laggers year-to-date, Apple still down 20%. They still have some tough sledding ahead of them. I think it's going to be a tough year for Apple. Lennar down 19%, Nike down 20%. Dividend yield portfolio. This portfolio up 1.4% in May, but year-to-date still lagging, down 2%. And just kind of as a reminder, this portfolio, large dividend paying companies, real good balance sheets. The reality is a lot of these companies are a little more multinational oriented. And with the strong dollar, that's definitely put pressure on share prices for these types of
I mean,
stocks.
these are some of the biggest companies in the
Right.
world, so they are multinational. They have supply chains that extend across the globe, and any sort of disruption, the dollar, the reserve currency of the world, is going to cause them some
Right.
issues.
So a little bit of a laggard. I mean, down 2%. It's not crushing anybody, but it's definitely dragging. Big gainers in May. Kimberly-Clark up 11%. Cisco Systems up 8.5%. PNC Bank up 8%. Laggers in May. AEP down 4%. Duke Energy down 3%. Bristol Myers down 3%. Seeing some pressure in the pharmaceuticals. Year-to-date gainers. AT&T, big winner there, up 22%. Darden Restaurants up 14%. American Power up 12%. Laggers year-to-date. Packaging Corp, which killed it last year. We've given back about 4% of that, or 14% of that Packaging Corp this year. U.S. Bank down 9%. Chevron down 6% year-to-date. Appreciation with income in May up 4%. Year-to-date up 5%. Big gainers there. Broadcom 23%. Amphenol up 14%. Meta up 13%. Laggards, Eli Lilly down 7%. Brinks down 8%. Sunoco down 8%. Year-to-date, Cigna, big winner, up 15%. Equitable up 12%. Lam Research up 12%. Meta up 11%. Year-to-date laggards in the portfolio, Energy Transfer Partners down 11%. Eli Lilly down 4.5%. Price potential, this portfolio struggled a lot last year. We turned over the portfolio really, call it the last month of last year and the first couple months of this year. Kind of a new mix in there. In May, we were up 9%, year to date up 2%. So, what we did looks like it's working. In May, big gainer, Celestica, up 29% in May. That was just bought in April. I think year to date, we're probably up closer to 65%. That stock's running. Dell in May was up 21%. Advanced Micro Devices up 16%. Texas Roadhouse up 17%. Laggards, once again, Nucor was down 9%. Fortinet down 2%. T-Mobile down 2%. Year to date, Meta's our big gainer in here, up 11% that we're still holding. Obviously, Celestica. Microsoft up 9%. Year to date laggards, Google still down 9% year to date. Amazon down 7%. We kind of had those going into the year. Like I said, we had a lot of turnover in that portfolio. The other pain point for us, really, laggard wise, has been our small cap portfolio. The Russell 2000 still, well in the red. In May, we picked up 1% in this portfolio. Year to date, it's down 11%. The nature of this portfolio has always been a lot of volatility. In May, Red Violet was up 22%. Universal Technical Institute was up 24%. Palomar Holdings was up 19%. Skyward Specialty Insurance up 18%. On the downside, Easy Corp down 14% for the month. TAT Industries down 11%. Year-to-date big gainers, Palomar up 62%. Red Violet up 35%. Like I said, a lot of turnover. Really don't have any big losers in the portfolio because we have turned over and been a lot of trading in that portfolio trying to get our footing. So really, that's where we're at.
And I would say too, when it comes to the small caps, it's been probably a tough 10 to 15 years in the small caps. in terms of performance versus the market. But again, from a diversification standpoint, we want to have exposure to those smaller and mid-sized companies. There is more volatility. You're going to see higher highs. You're going to see lower lows. There is more turnover in that portfolio. And generally, we try to use that portfolio in retirement accounts where you do have a longer horizon, so you can deal with that volatility. You can deal with that turnover because, again, generally it's in tax-efficient accounts, not taxable accounts. So it's part of having a well-founded, well-diversified portfolio. And obviously diversification means that not everything is going to work at the same time.
Well, that's exactly right. I mean, most client portfolios, if there's no exposure to the small caps, people are positive. We're to the plus side year to date. Even with a little bit of exposure there, it's kind of kept people either flatline or slightly negative. So it has been a detractor.
But it's still a place
where the returns come in spurts.
Yeah.
You have, we saw a decent 23, 24 in there, big returns, and any kind of economic uncertainty, you have heightened volatility.
Yep.
So that's kind of the outlook. Like I said, I think we're on a nice little run here. Earnings have been coming in better than expected. I think corporations, really talked down their earnings, and analyst estimates have been probably overly pessimistic. I think a lot of the narrative out there is probably a little more on the pessimistic side. So everybody's kind of erring to the side of caution. That tends to lead to a little bit of a market outperformance. So I see a little upside window here. And then as we get in the second half of the year, potentially another pullback.
Yeah. But we do see this with public companies is when there is uncertainty, like the tariffs, when there's major dislocations, like a financial crisis, it's easy for them to take all of the baggage that they didn't want to talk about,
right,
throw it all into a couple of quarters and just, blame it on something else, kind of wash their hands, clean up their balance sheet and move forward. And we're definitely seeing this now that companies are kind of retrenching, cleaning things up. They're talking down their earnings because right now saying our performance is not great because we're not a great company is damaging to your stock. Saying our performance is not great because of the tariffs or the war in Ukraine, what's going on here is the uncertainty is driving down our business. That's a lot easier to get a free pass from Wall Street. And so that's what a lot of companies do is they want to just kind of throw everything at it when they feel like they've got a good time to come up with an excuse.
Exactly. And that's the reality is all the estimates have probably come down too far. You get the outperformance that will drive upside on the market.
Yeah.
And right now the market is very sensitive to the narrative and the news and the headlines. That's, kind of the environment we're in right now, hence more volatility. And like I said, at least I think we got a little bit of wind at our back. But let's not forget, come July 9th, I believe it is, that's when some of these tariffs that were postponed could be kicking in. So by the end of the month, the noise could be getting a little bit louder. And
and we could have
the seatbelts on.
Yeah, keep the seatbelt on because we could have deals in place. We could have the tariffs pushed out again because negotiations are going well. We could have it pulled forward. We don't know right now.
But fundamentally, sound companies will do fine, and that's the reality. Is corporations will find ways to make money in this environment.
Absolutely. So with that, we'll talk to you again in another month. Hope you have a great one. And if you need anything, please feel free to reach out to us. As always, we appreciate the trust you place in Ellsworth Advisors. Thank you.
Thank you.